Let's talk about what the real benefits are for using a second and third tier lender. When we use second and third tier lenders, it's because you're capped with lending with the mainstream lenders. And I'm talking about, your big four, St. George, Bank, Macquarie Bank, ING, Bank West, etc. Well, with the mainstream lenders, depending on which lender you go to, they may shade rental income. They might discount the rental income by 10, 20, 25%. With a second tier lender, they may not even shade it. So there's already an extra 10, 20, or 25% rental income you can use on that. Good day everyone, I'm Tony Xia and thanks for joining me on another episode of the Mortgage Chat. Today I want to talk about why someone would use second and third tier lenders. So first of all, why would someone use a second or third tier lender? So most people would use third tier lenders, or what you call non-conforming lenders, is when they have low credit score, bad credit, credit impaired, etc. But for someone that's normal, good credit score, nothing adverse, why would they use a second or third tier lender? And the main reason is borrowing power. So first, let's talk about what the real benefits are for using a second and third tier lender. And I'm talking about banks like First Mac, Resimac, Liberty, Latrobe, Pepper, Bluestone, etc. Right? So all the lenders that's outside the mainstream lenders. All right. Now, when we use second and third tier lenders, it's because you're capped with lending with the mainstream lenders. And I'm talking about, your big four, St. George, Bank, Macquarie Bank, ING, Bank West, Suncorp, etc. When you've maximized your borrowing with those mainstream lenders and you want to keep borrowing money for investment purposes, that's when you start jumping into second and third tier lenders. And I'll break it down on what are the pros of using these second and third tier lenders. So first, I'm going to quickly talk to you about the difference in borrowing power when you're comparing major, second, and third tier lenders, especially when you're already holding some investment properties or existing debt. So on my whiteboard here, I just gave you a quick example, right? So let's just say I've got a single applicant that's on $150,000 a year. PAYG or self-employed, doesn't matter, as long as your taxable income is $150,000. You're living at home and you already hold two investment properties at 400 grand each, right? So 400 grand loan, that's what I'm referring to. And they're receiving $500 per week in rent. Now, so let's just say I want to purchase my third investment property with a proposed rental income. On the mainstream lender, I can probably get around $200,000 as a loan. Now, with a second tier lender, I can get up to 520. With a third tier lender, I can potentially get up to $700,000. Now, third tier lenders generally only works if you structured your existing loans with other lenders correctly. That's the only time when a third tier lenders will come in play. And you're probably thinking, why is there such a big difference on those three borrowing powers with different lenders or different tier of lenders? Well, the main thing is how they assess existing debt, and which is what I'm going to do right now for you. Okay, I'm going to tell you the difference in how each tier lenders would assess your existing debts or any future debts. Now, mainstream lenders will always have the strict criteria in their policy and how they assess existing debts because they're very regulated by APRA, ASIC, etc. So all your mainstream lenders will have similar assessment criteria. Okay. So now let's talk about why would a second tier lender allow you to borrow more than a mainstream lender? Well, with the mainstream lenders, depending on which lender you go to, they may shade rental income. They might discount the rental income by 10, 20, 25%. Now, with a second tier lender, they may not even shade it. So there's already an extra 10, 20, or 25% rental income you can use on that. Okay. And also with the mainstream lenders, they require you to add a investment property expense within the calculations. Now, with a second tier lender, they may not need you to include that rental expense, such as council rates, water rates, repairs, etc. Right? And also the big difference is the negative gearing benefits on the back end. So a quick example is with a mainstream lender, if your rate is 6%, they'll add a buffer on top of that, which is what we call a buffer rate of 3%. So instead of assessing your loan at 6%, they'll assess it at 9% just for stress testing, right? Which is an APRA requirement. But on the back end, if it's an investment property, even though it's assessed at 9%, you got negative gearing benefits on the back end. which they will only still use 6%. So they're going to assess your rate at 9%, but they only apply negative gearing of 6%. But with a second tier lender, if they assess your loan at 9%, they're going to use the negative gearing benefits on the back end at 9% as well. So that's why there's going to be that big difference on the back end, because there's more negative gearing benefits than a mainstream lender on the back end by about 3%. And that's why there was a big difference between a mainstream lender and a second tier lender of around $320,000, right, with borrowing power, because of the rental income, the shading, and also because of the negative gearing benefits on the back end. So now let's talk about third tier lenders, why their borrowing power is so much higher than your mainstream lenders by about $500,000, like what I just showed you. And the main reason is how they assess existing debts with other lenders. And that's why it's very important, if you want to use third tier lenders, your existing debts with other lenders, call it ANZ, St. George, has to be structured correctly in order to get that $700,000. And I'll tell you why. So the main reason why a third tier lender you're able to borrow more is how they treat existing debts with other lenders. So remember what I just said, if you've structured your loans correctly with ANZ or St. George, your existing owner-occupier or investment debts, it works very well with third tier lenders, especially when those debts are at interest only. And why is it better? Because with these third tier lenders, call it Pepper or Liberty, they will only use the existing repayments, what you actually pay with those banks, as an assessment. Now, depending on if it's Pepper or Liberty, they may add another 20% buffer on those repayments. Therefore, it's a lot more beneficial if your repayments are a lot more lower with those lenders. And that's why I said to you, it's very important how you structured your existing debts with those lenders, right? Because if those lenders are at P&I, principal and interest repayments, obviously it's going to be a lot more higher than interest-only repayments. So if Pepper uses the P&I repayments, then obviously your borrowing power will be a lot more less than what your interest-only repayment will be with those lenders. Okay, so right now, only Pepper and Liberty are the only two third-tier lenders that will use existing repayments, what you actually pay with those lenders outside of their organization, as an assessment in their calculation. This is why I just showed you the borrowing power could be the difference of $500,000 as a loan between a major lender and a third-tier lender with them, because they use existing repayments. And like I said to you, if you structure it correctly before you go to those lenders, it can be very beneficial for you. So essentially, the benefits of using a second and third tier lender is because, number one, the borrowing power is a lot more higher. And number two, it allows you to extend your investment property journey. So now I've just explained to you the benefits of using a second and third tier lender. You're probably going to me, Tony, why don't everybody use second and third tier lenders? Well, now I'm going to tell you the cons, okay? And the first con is going to be the rates are going to be higher. So on a second tier lender, the rates are generally around 0.4 to 0.6% higher. But with a third tier lender, call it Pepper or Liberty, their rates could be anywhere between 1% to 1.5%. Especially if you're a heavy investor, you have multiple properties, some of these third tier non-conforming lenders will actually add an investor loading on top of your investment rates, which is going to be a killer, okay? Because some of these rates sometimes can be up to 8.5% or 9% because you're a heavy investor. So you're probably thinking, Tony, why would someone pay those rates? Well, it's the cost of doing business to get more loans and to accumulate more property. If your mainstream lenders can't give you the loan you need, then you sort of have to go to a second and third tier lender and you pay that a little bit extra. It's better than doing nothing, right? So if you pay that extra 1% to get that loan for $500,000 and buy a $600,000 property, and that property grows by 10, 15% over the last 12 months, then you sort of would do that, wouldn't you, right? Because it's the cost of doing business. And that's why some of these heavy investors are willing to pay that extra 0.4 to 1.5% in rates just to get more properties and just to borrow more, get more borrowing power, accumulate wealth, etc. And the second and most biggest con is you probably won't be able to refinance these loans back to a mainstream lender, especially if they are investment loans and you're interest only. You have the risk of not being able to refinance back over, and those repayments change to P&I repayments from interest only. And you're probably thinking, why can't I just refinance back to a mainstream lender before the interest only term finishes? Well, that's because you overcapitalized your lending already. Remember what I just showed you with a mainstream lender, your borrowing power is only $200,000. And now if you go to a third-tier lender, call it Pepper or Liberty, you borrow $700,000. In the eye of the mainstream lender, you've overcapitalized your borrowing power by $500,000 based on their assessment criteria. So how the heck you can just refinance back to them, right? So the only way to really refinance back to them is your income increases, your rental yield increases, the rates drop, and a mixture of all those. Without those, you're pretty much stuck in the third-tier lender, all right? That's why you have the risk of not being able to refinance back to those mainstream lenders. Your interest-only term expires, and that interest-only repayment turns to P&I repayments, which means your repayments will increase significantly. Therefore, you might have a cash flow problem. That's why using a third-tier lender can be problematic sometimes, especially in the long run, once you've purchased and settled on your property, because you can't refinance back to a mainstream lender. And generally, when I tell a lot of my clients about this risk, that deters them from using a third-tier lender, unless their goal is to sell the property before that interest-only term finishes. Some will actually go, Tony, do you know what? I'll worry about that in the next 5 years when the interest-only term is about to expire, which is fine, right? So as long as they understand that risk, it's fine. Okay, so now you're probably asking, what income do I need to refinance these loans back to a mainstream lender? Based on the second-tier lender, if your income increases by $20,000, can be a mixture of salary and rental income by around $20,000, you can probably move those loans back from a second-tier lender, $520,000, back to a mainstream lender. Now, if you want to move your third-tier loans back to a mainstream lender, then you probably need an additional income of around 50 grand, and that could be a mixture of salary and rental income as well. That's assuming the rates stay the same. Obviously, if the rates drop, then that obviously the income needed to refinance back to a mainstream lender will also decrease. Okay, guys? So everyone, now you know the risk of using a second and third tier lender, which generally when I talk about the third tier lender, that deters a lot of people from using those third tier lenders. But second tier lenders, more than likely they'll jump on board because there's only around 0.4 to 0.6% difference. And some of these mainstream lenders have these special refinance policies where, you know, instead of assessing them at 3% buffer rate as a stress testing, they only use a 1% buffer rate as stress testing. Okay, so when you use a second tier lender, refinancing back to a mainstream lender using those policies, it's a lot more easier as long as your broker does that sort of calculations for you and tell you that, hey, you know what, moving back to a mainstream lender is not a problem. So it's very important that I showed you and told you about the cons and pros of using a second and third tier lenders, because a lot of these brokers out there don't actually tell you the risk involved. They just like to tell you the benefits, right? Benefits are great in the short term, but the pain can come at the long term, especially when the interest only term finishes. So there it is, everyone. Hope you enjoyed this episode today. Hope you learned something. Hope to see you in the next episode. Thanks for joining me on another episode of The Mortgage Chat. I'm your host, Tony Xia, and I'll see you next time.